Good afternoon, everyone. We welcome you all to today's live streaming session. Before we start, we want to know how where you have come from. Just let me know in the comment section, so I'll be getting an idea where you are coming from and what do you want to gain from the market. What are your expectations from the market, right? And today we'll be also getting insights into the analysis. What analysis? We'll be getting insights into the economic analysis, how it helps in stock market investment, how it helps shapes our investment strategies, right? And how economic analysis can play a very important role for the investment in stock market. So we will get each and everything into it. Before that, for those who don't know me, my name is Aditya. I am your live streaming analyst for today. uh, Talking about my background, I started my professional journey 7 years back, and till then, I have been continuously monitoring the market. I have been experienced in equities market, been experienced in forex market as well. So you can be rest assured where you are getting the advice, right? So starting from the analysis which we have done till now, we will start with the what performances which we have done, the stock holdings which we have till today, what were their performances, and then we will go to the economic analysis and how it helps in stock market investment, right? So before that, we will look into our holding. This was our holding for today, right? This was our holding, and we have seen some of the stocks growing and some of the stocks being negative. So we'll just go through our holding and let analyze how it is doing for today. So we have eight stocks in our holding as of now, and we have seen that since the market is closed, most of the stocks has been closed negative because there are many uncertainties happening. Right? Can you let me know what are the uncertainties happening in the market? Please let me know. Right? So even I can know how much updated you are in the market and how much insights you are getting. So we'll be able to see how much knowledge even our students are holding, our viewers are holding, so that we will be able to provide according to our uh, accordingly in our live streaming. So there are many viewers which we will see who are just new in the markets, right? Like there are three categories of viewers uh, who are watching our live streaming analyst live streaming. So first category, we have the newbies who are like who have just entered into the market, just trying to learn about the market and gain insights into that. Second, we have the persons who are trading in the market but are not profitable, right? They are still running, they're still trying to gain some insights on how to be a profitable trader. And third one, we have our traders who are profitable, we call them expert, right? So these are the three categories of trader, and this session will be helpful for each and everyone to understand how from newbies to expert, how economic analysis is helping you to gain and make your investment smarter in the stock market. So before that, we have seen our performances. This is our changes in our stock which we have in our holding. It is negative. Most of the stocks are negative because the market is not supporting at this level. Market is quite consolidating. From the last 5 days, we have seen market has been consolidating, and it is not, it is trading around the range of 24,400 24,700. So it is trading around that range, and if it breaks, we can see that there is a strong resistance at the level of 24,700. So if it goes above that, we will be seeing some bullishness coming into the market. So this is the status of stocks which we had today. And talking about our performances till date, we have we will just look at the performances. So we have made 227% of profit till now, right? The 227% profit Can you guess like at what time we have traded and what are the number of trades which we have executed? We have only executed 37 trades till date. 37 trades. So this was the trades which we have made, and the profitability is 227%. And any guesses about the timing, guys? Like what are the how much time it took to reach us the profitability of 227%? Any guesses? Right, I will let you know. In just 3 months, we are able to gain the profitability of 227%. So just think about the profitability which we are generating, the consistency which we are maintaining. Out of 47 trades which we have entered till now, we are able to generate you with the profitability of 227% in just 3 months. It's not even 3 months. We have started giving you recommendation on 18th of September. The 3 month is still to come. Before that, on and around 3 months, we are able to provide you with the returns of 227%. And we have closed just 37 trades. We are not providing you the call on a very frequent basis, like 4 or 5 in a day. We provide you with the recommendations a very of quality, either it is one or two on a daily basis, and then we provide you with the recommendation, right, where you are making a consistent gain in the market. Remember, uh, it's not all about like timing the market, right? It's all about time in the market. The more time you will give, the more you will understand the market, and the more consistent gain you will be able to achieve. So just remember that. And as of now, we will start with the economic analysis, right? So can any one of you tell like what do you mean by economy? Like how economy impact the stock market, how it is reflected, right? We even will go to the Buffett indicator as well, like how Warren Buffett have explained the GDP versus stock market, how it correlates, and when it goes above 100%, and how it is correlated to the stock market. So we'll go through each and everything, but before that, we will just get up some ideas how it is affecting the stock market. For today, our topic for PPT for today, our topic for PPT is how economic analysis helps in stock investment. So it is a very critical to understand how economic analysis will be helping you in the stock in your stock investment, and it is very important to understand all of these concepts. Right. So we will be understanding the impact on economy, right? Impact on the industry, the sectoral impact, and also on the individual effect, like how economy is affecting on the industry, on this sector where the stock is listed, where the stock is doing its business, also on the individual stocks. We will go through each and everything in very detail. So starting with the introduction, we know that economic analysis is crucial for stock making stock market decisions, right? It helps investors navigate market complexities, right, influenced by macro and microeconomic factors. So what do you understand by micro and macroeconomic factors, right? What do you understand by it? So macroeconomic factors like covers the major impact, like the global impact, right? Like the global impact, we can consider it GDP, inflation, interest rate. These are the macroeconomic effects which take place in the market, and from then it affects a lot. The macroeconomic indicators affects stock market a lot on a major basis. And the microeconomic analysis will be helpful to understand the businesses which stocks are performing. The industry analysis, we can go microly, like how the industry is doing, how the businesses is running through. So for that, we do the microeconomic analysis. So this is all about macro and microeconomic analysis. These are the two parts of economic analysis we will be dealing with, and we will be understanding how these two are helping investors to make them the smart investment in the market, right? So we it covers, as we have come to know, it covers the impact on economy, industry, and individual companies, right? Also, what is economic analysis? It helps in, and it helps in studying about the factors like GDP, gross domestic product, which plays a very important role in the terms of growth. If the GDP of a company is doing really well, then we can assume that the stock market will be following its mark, right? When the country grows, the company in the country also tends to grow significantly, and we will be getting significant returns on that. Also, we have to analyze on which segment our country GDP is going, like which sector GDP is going much at a faster rate than the other sectors. So these are the questions which you have heard, and we will be explaining regarding that only. Also, we will be talking about the inflation, how inflation is affected, how inflation, what are the effects of inflation in our day to day life, how inflation reduces your purchasing power, right? How inflation reduces the purchasing power on a yearly basis. Remember what we have gone through the yesterday analysis, that a dollar worth today is much less than the dollar worth tomorrow. What do you mean by that? That means that whatever goods you are able to purchase from a dollar today, you will be not able to purchase it tomorrow, because there is a thing called inflation. It increases because of the price of the goods keeps on increasing on a yearly basis. So if you have $100 of goods you can buy today, you won't be able to buy it tomorrow, because there is a inflation is increasing, right? And all the things are becoming expensive. So that's why inflation plays a very important role in it. Also, we will talk about the interest rate, what how interest rates affect the market and unemployment, right? When the country is facing with lot of unemployment, right, there is not much employment available in the country, we'll be looking how it affects. It reduces the cost of earning per person, it reduces the cost per capita income. So we will get to know each and everything about it. Suppose there are 100 people who are in a country who are earning rupees $100 a day, right? So their GDP will be established, like their GDP will be much more stable. And there are, suppose in a country we have a people, only 60 people are working out of 100, and they are earning $100 per day. So that makes a per capita earning of a country very low, because only few people are working. And while comparing the per capita, we have to compare all the peoples living in a country. So due to that, the per capita of a country decreases. As we have seen, in India, we have a many population, right? There is a population of 140 crores, and we have a GDP of around 4 trillion, right? We'll just go through the examples. We will just go through the live examples, and let us understand what is the per capita GDP of India. We will just go through it. The GDP of India is 388.9 billion dollar. Okay, and what is the per capita? So the per capita for India is 2698, because we have a population of 144 crore. If we divide the population by this number, by the GDP, we will get the per capita income easily. And now look, the China, we will compare with the China, because China is close to our population, and we will compare what is their GDP and what is their per capita income. So China have a GDP of 17,794 US billion dollars. Okay, and China has a GDP of around 12,969 dollar at currently. Okay, so what is the difference? Why India is having such a low per capita income? The GDP is the GDP is around 388 9 billion. It is among the fifth largest economy. Okay, even after being the fifth largest economy, it should be rich by it should be rich according to the per capita. But why it has decreased? Because the population in the market in the India are very much high. There is a population of 140 crores in India. So dividing by that, we get the per capita income. Right, it's around 2698. And for China, the GDP is much more higher. It is third. It is, I guess, second in ranking as per the GDP, just below the US. Okay, United States, and it has a per capita income of 12,969. So this is the per capita of China, and we have a per capita of India of 2698. So it is quite low as compared to China. Even after having the population equal, it all comes down to GDP, how much GDP a country is having, and then we can get the per capita income. So it matters a lot, your GDP, overall GDP. Even after being the fifth largest economy in the world, we are having a very less per capita income, right? And if you look at the per capita ranking, it is 144th out of 194. It is a fifth largest economy, but if you compare with the per capita income, it is around 144th position out of 194 economies. So just look at it, how this economy, like how the economy analysis is helping you to understand the core of the GDP and per capita. If you look at the from above perspective, you will be getting to know India is a very rich country, right? But if you divide it by the total number of population, you will come to know that the per capita income is very low for a country because it has a large population. So this is the thing which we have come to know about the GDP. Now we'll go back to the PowerPoint and make you understand all the other factors as well. So we have come to know, like, it helps in GDP, it helps in inflation, also the interest rate and the employment. Also we will so it also helps in assess economic health and predict stock market. uh, So Harsh have come up with a question, like he's asking what is better, high GDP or low GDP? Like Harsh, we can as we have seen, China has a high GDP, but it has maintained it per capita growth, right? So when a GDP is even if the GDP is low, I will explain you with an example, a Qatar example. When even if the GDP is low and the population are low for a country, we can have a good per capita income. GDP of Qatar. Look, this is a very small country. We have a GDP of $235.77 billion for a Qatar. Okay, and what will be the PPP, per capita of Qatar? So you can look, per capita of a Qatar on an average is around 87,480 US dollars. So it is much higher, right? So it is much higher than the India and of China. So even if the GDP is low for a country and if the population is low, so the per capita will be good. So it all depends on the geography of a country. If the population is low and the GDP is also low, but it all depends on the population. If the population is much more lower, if we divide the population by the GDP of a country, we will get the per capita income, and it all depends on a per capita. Per capita plays a very important role apart from GDP. Even after having a fifth largest GDP in the world, India is having a positions of around 144th position in out of 194 countries. So it is quite low. It has to increase its GDP to come to the level of China, US, and Qatar. It is far behind that. So this is the conclusion we have for the GDP. Either a small GDP is low or a big GDP is good. Okay, I hope you got the point, Hers, and we will come back to our presentation. If you have any doubt on that, we can come up with that. So we have done with the economic analysis. Now we will come up with the role of economic indicators in stock investing. What are the economic indicators that helps in stock investing? So it is like GDP growth, the inflation, the interest rate, unemployment rate. An example we have will coming with GDP growth, right? Economic health influences corporate profits and economic stock market. Like there are many economic factors which affect the corporate profit as well, because when the economy grows or slows down, there is a overall effect in the market. People consumption grow, people consumption become high. When the economy is growing, people consumption become low. Due to that, the the rate of consumption becomes low, so the profit will be also low. And when the rate of consumption is high for a consumer, the profit will be high for the organization as well. So it affects a lot. The GDP growth also affect a lot, right? So coming to the inflation, we have already talked about it. It affects the purchasing power and input cost as the year goes on. As we have a less of a purchasing power in coming year, like a dollar worth today is much less than the dollar worth tomorrow. Also, interest rate, it affects the borrowing cost and market performances as well. So when the borrowing cost will be high, the industry or the people will be tend to borrow less of a money, and it will affect the employment. It will affect a lot, right? So the when the purchasing power, like when the loan taking capacity becomes less, the investment in the economy goes less. As we have seen in the US market during the corona period, when there was a recession going on, the government have allowed company to take loans on a very low interest rate. Due to that, investment in the market grew, and economy start taking up its pace. And due to USA market, overall world economy start becoming stable, and the world economy start growing post the COVID market. So all of the things are important. The interest rate plays a very crucial role. And on time to time, we have seen Fed coming up with interest rate, and it affecting our stock market a lot, right? Also, we previously we have discussed about the unemployment, right? How low unemployment boost spending and stock prices. So when the people will be employed in a country, right? When there will be low employment and most of the people are employed in a country, it will obviously boost the spending power of a consumer, right? It will boost the spending power. The people will tend to spend more, will travel more, right? And when the people are unemployed, it doesn't boost your spending power, because you will having less of a money. You don't have any source of income, so how you will be going to spend that money, right? So these are the things you have to keep in your mind while analyzing the stock investment. How economic analysis will help you in investing in the stock market, right? Also, we can see there is an example. GDP growth boosts sectors like consumer goods, tech, and financial. When the GDP is growing, we can see there is a growth in FMCG sector, because the consumption becomes very high. There is a growth in technology. The product which technology is inbuilt is being sold at a very high pace, right? And the financials also grow when the transaction took place from bank to bank. Whenever the transaction we do through all the cards, it will be increasing, so the bankings will be going strong, right? We have come down to the macroeconomic analysis, how macroeconomic affects the market. If you know about anything about macroeconomic analysis, please let us know in the comment section, right? What do you understand by macroeconomic analysis? We have been hearing a lot how macroeconomic analysis affects the market, so we'll come on that. What are the macroeconomic trends? We will know it's global economic condition, inflation versus deflation, and interest rate cycle. So, what is inflation versus deflation? Right, inflation, as we come to know that the purchasing power keeps reducing, but deflation, it's the reverse of that. Our purchasing power keeps increasing year on year. A dollar worth today will be more than the dollar worth tomorrow. Just remember that, because our spending power will be more tomorrow. In case of deflation, then it is on today. We will be able to purchase more of our goods tomorrow, right, than today, because the deflation is going on in a market. So you have to keep your dollar safe as of now, so you can spend it later and get more of a goods. Also, there has been government policies and physical stimulus can impact stock market. As we have discussed that COVID-19 physical stimulus helped take and healthcare stock. In the USA market post COVID, we have seen there was a strong stimulus packages given to the people. Due to that, it helped the technology sector and the healthcare sectors to grow, because people were able to take care more of their health, and were able to be protective from the COVID-19, and for that they require the healthcare, and for the require the healthcare products to be inculcated, and the healthcare stocks grew. So what are the macroeconomic analysis? Focus on individual companies, right? So it focuses on earning reports, it evaluates the performances, right? It it focuses on profit margins, it focuses on competitive advantages, it focuses on management. So these are the few things on individual companies where macroeconomic analysis can help you, where it focuses on management, what management is doing, what are the decision making are affecting the company, what are the competitive advantage a company is having, and what are the margins, like profit margin it is generating, right? So, overall, if we see the impact of economic condition on stock market, what are the economic expansion, right? So, low employment, rising wages, consumer spending boost stock prices. So, when economy is expanding, right? So, when there is a low unemployment, when economy is expanding, we will see the people are working more, the employment will be low, and due to that the consumer spending power will be getting boosted, and the stock prices will be rising. And subsequently we have economic contraction as well, like when the economy is going through recession there will be a high unemployment. High employment means low consumer spending, and it will lead to it will lead to hot year stocks. So these are the things we have to keep in mind. When the economy expands, there is a low employment, no low unemployment, and there will be a rising consumer spending as well, and it will be boosting your stock prices. And coming to the interest rate changes, in rising rates shift focus from growth to value stocks. When there is a rise in interest rate, the bank will be getting a less of a loans. Bank will be tend to get less of a loans, and it will reduce the expansion policy. Like it will be reducing the investment. It will be reducing the investment power of a bank, and due to that, it will be impacting the economy as well. It will come to a slowdown in economy. For from then, the focus will be on the value stocks rather than the growth stocks. We have come up with an example. We have seen 2008 financial crisis, which have caused global market downturns. What are the economic impact on specific sectors? So there are many economic impact, and we have seen the cyclic going on, right? There are cyclic sector as well as defensive sectors in our stock market investment. So what are the cyclic sectors? Like consumer, discretionary, industrial, financial perform well in expansion. So if we look the cyclic sector, it performs well. It performs very well during some cycle. Suppose a festival is coming, or there is a purchasing of goods going on during Diwali, during festivals like Diwali and Dasera, we will see the prices of gold stocks performing really well. Right? And for the defensive sector, we have healthcare, utilities, consumer staples, where the demand is never ending. So these are the defensive sector. Even where you are having a recession, depression, or a high economy, the demand for healthcare goods, the demand for consumer goods won't be falling much. So we can see an example that automobile industry struggles in recession, healthcare industry performs steadily. So when we go through the recession, automobile luxury goods go fall or down, right? The demand for the luxury goods go fall a lot, and the healthcare product sectors are steady because there is no much less of a demand of a healthcare products. Now, how can we use economic data to make stock investment decisions? So we can combine micro data to predict stock performances. How we can help that? Right, we'll just come up with an example. Like take stocks thrive in low interest rate environment because they are able to purchase more, like they are able to get more of a loans, and they will be able to reinvest their money and get some high returns. They will be able to reinvest their money in R&D. They will be able to reinvest their money in innovations, due to which the tech technology sectors starts growing. Also, energy stocks influenced by global oil supply chains. As we have seen, there is a lot of oil prices changes from day to day basis, due to which energy sectors which are dependent majorly on global oils fluctuates a lot. What is the role of inflation in stock investing? Right, inflation has dual impact. Low inflation boosts corporate profits. High inflation reduces margins. So whenever there is a high inflation, it will reduce the margin because the inflation will be high. The company won't be able to sell its goods at a higher price, at a good margin. So it reduces the margins. Also, then we can have a protection from inflation as well by getting into the real estate, energy and commodities at hedges. As we have seen, the prices of gold and real estate keeps on increasing with the inflation. As the inflation grows on, the prices of commodities grows as well. uh, we have an example, gold stocks often rise during the period of high inflation. So as the inflation goes on increasing, gold prices keeps on increasing. What is the impact of interest rate on investment decisions? So rising interest, reduce consumer spending and borrowing costs. We can see the examples are Tesla benefited from low interest rates, boosting electric vehicle demand. Right. Also, there are fear and greed cycle. Emotional investors' response affect market stability. Also, there are herding behavior, and examples are given. The dot com bubble 1999 to 2000. Over optimism led to inflated stock price. We will also come to know about the Warren Buffett indicator, how it affects the market, the GDP versus the stock market indicator. So just go through that on a very quick note. So this is the Buffett indicator. We have market capitalization to GDP. How market cap is related to the GDP, and when it becomes more than 100%, why we are able to see fall on that. So just look at the Buffett indicator during. We'll start with the 2000 area. Like we have seen, the Wilshire 5000. It is a index for the US. To GDP was 132% in 2000, in the year of 2000, right? So there was a dot com bubble occurred, and after that we can see there was a fall a lot, and the Wilshire 5000 to GDP ratio came down to 70%. So it made a very smart investment opportunity. As you can see here, if it is below the 100, below 100, it makes you the opportunity to invest in the stock market and gain some returns on it. Because when the market cap to GDP becomes more than 100%, it is very risky to invest. And we will also see in the current scenario how it has become so high. It has crossed 200% mark. And coming to the 2007, you can see there was a housing bubble which occurred in USA at 12 October 2007. And from then, the indicator, the Wilshire 5000 to GDP ratio reduced down to 52.88%. Just imagine the percentage it has fallen, 52.88%. And again then it started growing, and we have seen there was a fall in 2020 also. In 2022, after the corona occurred, just look at the, it was 160%, and after that there was a great fall till 131%, and after that it keeps on increasing as of now. But we are expecting from 1972 it was very stable, it was very good, it was a very good opportunity to invest. But as the Wilshire of 5,000 to GDP has grown, it is coming down. Just look at it, the price of the stock markets are coming down, the prices of the stocks are falling continuously. So the GDP which we have seen currently is at 208%, which is very risky. The market cap to GDP is very risky as of now, right? And we have to be very safe because the market is at very risky position. And the Buffett has interpreted that, also known as the market cap to GDP, gain permanence as a long-term valuation indicators for stock, largely due to Warren Buffett endorsement. Because we know Warren Buffett is one of the largest investors in stock market, and due to its endorsement, it is probably the best signal measure where the valuation stand at my given moment. So we have known about the Buffett investment strategy, how he have invested in the stock market and gained billions of dollars, not even millions, billions of dollars in the market, and the profitability which Warren Buffett is able to achieve. So he simply just calculate what are the market cap of a company, and it compares to the GDP and comes out to a formula, and it calculates if it is more than 100%, it is not advisable to invest. If it is less than 100%, it is advisable to enter in the market, because the role of fear and greed plays a very important role here. Now we'll come back to our PPT. We will know how behavioral economic and investor sentiment, right? Behavioral economics and investor sentiment. So fear and greed cycle we have came to know. So what are the case studies? Economic analysis in action. So case study, if you see Apple, we have an example of Apple. Economic environment, strong growth, low unemployment, low interest rate. So how the Apple will grow? It has increased its sales, stock price growth. So when the economy is growing, there is a strong growth and low unemployment. The Apple products will be becoming more demanded, because there is unemployment. The purchasing power have increased for a consumer, so they will buy more of a Apple goods, so luxury goods, right? And case study, the Ford Motor Company. So in recession, high employment, there is a decline in sales, because people will prefer less of a luxury goods, less of a cars to travel. They will prefer more of a road transport, the vehicles which cost a less price to travel, right? In conclusion, we have what we have learned till now. We will come to a conclusion for that. Economic analysis, both macro and micro, is crucial for stock market investing. So this is the conclusion we have as of now, and how macroeconomic factors shapes overall market condition, right? And microeconomic factors have help you evaluate specific stock opportunities. So in microeconomic, we go through the analysis of industry, how the management is performing. On the macroeconomics, we look after the GDP, inflation, and everything. And fourthly, we have informed decision lead to a better risk management, right? So we have to be informed, we have to analyze each and everything, so that we can make a decision on a better way and lead to a better uh, risk management. So thanks for watching today. We have come to a conclusion of our session. We have gone through the analysis, the economic analysis, and how it helps in the stock investment, and we have understand its impact on economy, industry, sector, and individual stocks. So if you want to gain more of insights from that, just stay awaited, stay updated on our live streaming platform, so that you are able to gain more of a knowledge. And till then, happy investing.